The price chart has two axes. The y-axis represents the spatial dimension of the market where we can see price fluctuations in terms of magnitude. The x-axis represents the temporal dimension in which price fluctuations occur. The combination of both axes enables us to see the fluctuations of price over time in an organized manner. However, when we look at price charts, we often get the impression that there is a hidden force driving the market, and we cannot really tell what this force is doing most of the time. We can only see its reflection on price volatility somehow. We call this hidden force the market momentum, which can be defined as the invisible market inertia or the net result of buyer power against seller power. The tricky thing about the impression of market momentum is that it can be misleading most of the time. For example, price might be rising ferociously without too much momentum behind it. On the other hand, price might display low levels of volatility with a significant degree of momentum behind it. The thing is that we can observe a synchrony between price action and its perceived momentum. There are two possibilities. Price can be coordinated or out of sync with its apparent momentum. This is where the idea of divergence was born. Since we have a few indicators to measure market momentum, we can see this discrepancy happening in a more tangible way. The classic technical indicator used to measure momentum is the relative strength index, which has the advantage of displaying the magnitude of market momentum independently from raw price action. Notice that we are not trying to smooth price action with the relative strength index. We are trying to create a visual representation of market momentum with it. That's in agreement with the Bonini's paradox that was outlined in previous lectures. Once again, we are not attempting to find a linear formula for the market momentum. We are simply trying to catch the moments where raw price action and its measurement of momentum seem to be out of sync by mathematical standards. That's the best we can do to measure market momentum. It is worthy of noticing that the relative strength index was attributed with some functions it is not capable of performing over the years due to the experimental nature of technical analysis. One example of this is the idea of overbought and oversold levels in the relative strength index, which is a too bold and ambitious idea to say the least. This indicator is built in a fixed scale, so it naturally produces distorted levels because it's trying to reflect price, which is not represented in a fixed scale. This idea of overbought and oversold levels is clearly bad because of this. However, the idea of divergence is a good one because we can take the relative strength index weakness and turn it into a useful tool. Divergence is a very common idea in the markets, and many traders give up on it because this idea by itself is useless, especially in the way it is usually presented in technical analysis manuals and so on. The idea of divergence is good, but it is hugely incomplete without the extra layer of fractal analysis and the understanding of how to perceive the different market flows. Just as a parenthesis, many traders commit the mistake to look for the all-powerful technique of the markets, and they inevitably end up being frustrated in their search. That's common in the markets because a lot of people have an inherent drive to find a quick and simple technique that will turn trading into an easy task. Traders with that kind of mindset are basically shooting themselves in the foot. By using a one-dimensional technique and expecting it to behave like a multi-layered tool, the trader is assuming this simple tool has a lot more power than what it actually has. This is a paradoxical behavior, and unfortunately, it is highly intuitive because we have cognitive biases that drive us to find the simplest solutions to our problems, which are not always considered to be the best solutions. Most traders don't like the idea that the markets are complex, so they immediately gravitate towards the notion that the smart thing to do is to keep things simple as far as the market analysis goes. Ironically, that behavior is the opposite of being smart about the market. Unfortunately, the market cannot be compressed down to the level of univariate tools. The variable that needs to adapt is the trader, not the market. In other words, the trader needs to adapt to the level of complexity of the markets instead of the market adapting to the level of simplicity of our primitive biases and need for cognitive comfort. Divergence is a popular technique, but since many traders insist in this unreliable mindset I've been describing, they never end up accessing the true power of this tool, and of many other tools for that matter. With that said, simple divergence by itself is a poor tool. We need to take this idea to the next level of complexity through the lens of fractal analysis and combine it with other good tools to form a good strategy. Divergence is just a way of visualizing the discrepancy or asymmetry between raw price action and its perceived momentum. Since we are going to explore this idea in its full potential, we are also going to analyze its weaknesses, so you can have a good idea of the precautions you must have with it. Let's analyze a few conceptual examples to understand exactly how we can measure momentum and divergences by comparing the highs and lows in price action with the highs and lows in the relative strength index. First, we should point out that there are two modes in which price can be in. The fluctuations in price action can be coordinated with its perceived momentum or out of sync. When price and momentum are coordinated, price action creates a higher high or a lower low, and the relative strength index also produces a higher high or a lower low. That basically means that price is displaying the same amount of momentum that is being measured by the relative strength index. When price and momentum are out of sync, there are two distinct situations that can happen. The first and most common of them is called a reversal divergence. The second situation is called a hidden divergence. A reversal divergence when price is going up happens when price creates a higher high and the relative strength index creates a lower high. That basically means that price is going up, but it has a low amount of momentum sustaining this movement. If the divergence is legitimate and not simply a distortion in the way momentum is plotted on the chart, price will reverse after it. By the same token, when price is going down, a reversal divergence happens when price makes a lower low and the relative strength index makes a higher low. Needless to say, this works in the exact opposite way of an upward market. The hidden divergence is the opposite of the reversal divergence because instead of signaling a reversal, the hidden divergence signals a continuation in the overall movement of the market. In an upward movement, a hidden divergence occurs when price makes a higher low, and the relative strength index makes a lower low. The logic behind this is that the price seems to be reluctant to display the same amount of magnitude observed by the plotted momentum. In a downward movement, a hidden divergence occurs when price makes a lower high and the relative strength index makes a higher high. This is where most of the traders in the market stop learning about divergence. However, we are going to take these two types of divergence and we are going to layer them together in different fractals to see the results. As it was pointed out already a few times, the way to do that is by using the idea of fractal analysis, which is going to be explored in the next lecture. In this lecture, we are going to take a closer look to the idea of fractal analysis and what it means in a conceptual form, so we can have a better understanding of its practical applications later in the course. The key to grasp the idea of fractal analysis begins by knowing what the word fractal means. We can define a fractal pattern as a pattern that repeats inside and outside itself in multiple degrees. The name of the fractal flow strategy comes from the idea that we can always observe separate market flows in different fractals, and these flows go in and out of coordination on a constant basis. To bring this idea to a more pragmatic approach, in any given timeframe, we can observe at least two market fractals. By market fractals in this case, I mean sets of highs and lows that appear to be in the same degree. This is an important observation because sometimes is not so clear in which fractal a market movement is. That's one of the reasons why we studied the subjective interpretation of price as a foundational principle. However, this problem will be explored later in the practical examples. For this lecture, we should only worry about the idea of market fractals and fractal analysis in general. To facilitate this notion, let's first define the idea of market vectors. Market vectors are the building blocks of highs and lows, and we can define them as the vector that come out of a high and end in a low or vice versa. Let's begin with a simple example. Imagine a simple upward market movement that we can call market vector. What you will notice is that this larger vector is formed by smaller vectors like you see in this conceptual example. These smaller vectors are also formed by even smaller vectors. This idea goes until the smallest market element, which is the tick or the smallest possible variation in price. This lens of fractal analysis is what creates the possibility to triangulate exact points of entry and exit in the markets by watching how different market flows interact with each other. This idea can be conceptually expressed in a more condensed way using the circle paradox. Imagine that you are looking at a two-dimensional circle from a given distance, but as you look closer, the circle begins to look like a polygon with a very large number of edges. The paradox dwells on the notion that the geometric figure is a circle and a polygon simultaneously depending on how far away we observe it. Fractal analysis is what makes it possible for us to see the edges of the market by breaking it down into its smaller components, so we can view this idea as a metaphorical magnifying glass. By being able to see the edges of the market, we can see where the market stops to reverse into the next move. This idea is a double-edged sword because it enables us to access a greater level of analysis, but it makes it a little bit more complex than what we would like. This complexity comes from the confusing nature of market flows, which are composed of market vectors that go in one direction. For example, an upward market flow is composed of higher highs and higher lows. However, within these higher highs and higher lows, we have downward movements happening in lower fractals, and even smaller upward movements happening in an even smaller fractal. These market flows often collide with each other. The job of a trader is to make the correct judgment about the strength of each market flow, and which one will dominate the next movement of the market. This is why we use the hierarchy of trading signals as a foundational principle in our trading. This is also the reason simple divergence without the more sophisticated layer of fractal analysis won't work properly. In other words, without fractal analysis, there is no real point of reference in terms of the perceived power of the signals generated by the relative strength index. However, the more complicated aspect of fractal analysis lives on the collision of market flows. The recognition of fractal divergence is relatively straightforward. We will explore the dynamic of market flows more deeply in another lecture. For now, it's important for you to grasp the overall idea of what fractal analysis means. The next step is to understand how to apply the layer of fractal analysis to the study of momentum divergence. That way we can derive two more sophisticated techniques called fractal reversal divergence and fractal hybrid divergence. These two new techniques will later give rise to another price action technique called fractal bar. In the next lecture, we will explore the fractal reversal divergence concept in greater detail. In this lecture, we are going to explore the first advanced technique derived from the combination of simple divergence with fractal analysis through the gate of multi-timeframe analysis. If we take the concept of fractal pattern that we studied in the last lecture, and apply it to the idea of simple divergence, we will arrive at an interesting idea. Since a fractal is a pattern that repeats inside itself, a fractal divergence is a simple divergence that happens within another simple divergence. The other conclusion is that this idea can happen in multiple degrees, so we can have maybe 3 or 4 simple divergences happening within one another, which increases the level of accuracy of our entry and exit points in the market. To be able to see this happening in a chart, we need to define the notion of divergent price territory, which is what will enable us to look for smaller divergences in smaller fractals. Divergent price territory is when raw price action and momentum are out of sync. For example, when price makes a higher high, and the relative strength index fails to make a higher high, we enter in price divergent territory in an upward movement. The opposite is true for a downward movement, of course. At this point, we can go to a lower timeframe to find another simple divergence happening within the already divergent price territory. When we find a simple reversal divergence happening inside another divergence, we call this pattern a second-degree fractal reversal divergence. When we find 3 simple reversal divergences happening within one another, we call this pattern a third-degree fractal reversal divergence. Let's conceptualize the fractal reversal divergence to solidify our understanding of the idea. To identify a fractal reversal divergence in at least 2 fractals, first we need to observe a simple reversal divergence happening in real time. Once we identify that, we draw a rectangle to point out the divergent price territory for the lower timeframes. After that, we jump down to the next lower timeframe and wait for another simple reversal divergence to occur inside the divergent price territory outlined in the higher timeframe. That's the basic framework of a fractal reversal divergence. If you wish to identify fractal divergences with higher degrees, all you need to do is to repeat the same steps again. A third-degree fractal divergence would happen when you were able to see a simple reversal divergence within a divergent price territory, and this divergent price territory would be inside yet another divergent price territory. If you study this idea in your price charts, you will notice that fractal reversal divergence is capable of pointing out extremely precise points of reversal in major and minor fractals in the market. However, now that we already know the strengths of the concept, let's explore its weakness. The fractal divergence concept is a good idea, but let's not forget that it still comes from a simple technical indicator. For example, if you decide to use the fractal divergence concept by itself, which is a bad idea, you will notice that sometimes price appears to be in a reversal point in a textbook example of fractal divergence, only to find out that price will mislead you, and continue in its original direction for a few more vectors. This is precisely the reason we studied the contextual trading principle. In other words, you cannot trust the fractal divergence idea by itself. It is merely a precision tool that needs to be used in the right time. However, we have an operational logic guideline that helps traders in these situations. Often when you see a floating fractal divergence without any other techniques pointing to the same area, you can assume that price is playing a subtle sleight of hand, because you will often find fractal reversal divergences happening in a lower fractal that agree with the overall trend. Remember that it is always much easier to trade in the direction of the trend. The right time to use the fractal divergence will be defined by the context of the trade. For example, if you happen to see a fractal divergence in the same price level where major support resistance lines are agreeing with the analysis as well as the raw price action reading, you can think about forming a trade idea if the potential risk parameters of the trade agree with the concept of long-term sustainability, which we will explore in later lectures. In the next lecture, we are going to explore the fractal hybrid divergence idea. In this lecture, we are going to take a closer look at the fractal hybrid divergence, which is an idea derived from the collision between fractal analysis, hidden divergence, and reversal divergence. The hybrid in the name of this technique is a reference to the fact that it uses a blend of two techniques that are not usually used together. The term fractal obviously means that the hybrid divergence can only be recognized with the extra layer of fractal analysis. As we studied in previous lectures, a hidden divergence signals a continuation in the overall movement of the market, which is a safer place to start our chart analysis rather than looking for price reversals. That's because trading with the overall flow of the trend is a much safer and less risky endeavor than trying to pick up the ultimate price reversals. The fractal hybrid divergence is an accurate way of catching unique momentum asymmetries in price by layering two opposite techniques together. Once again, this is only possible by using the concept of fractal analysis to find these opportunities. The fractal hybrid divergence is composed of a hidden divergence in the higher timeframe or in the higher fractal, and a reversal divergence in the lower timeframe or lower fractal. Just like the fractal reversal divergence, the hybrid divergence can appear in multiple degrees. It's worthy of noticing that only the first degree of the fractal hybrid divergence is composed of a hidden divergence. All the subsequent degrees you will be able to spot have the reversal divergence structure. Let's try to conceptualize this idea in a clearer way. The first step of spotting a fractal hybrid divergence is identifying a hidden divergence in what you are going to call the higher timeframe. Here we can use the same concept of divergent price territory that we used in the last lecture. Once you determine the divergent price territory, we can jump down to a lower timeframe to try to spot a reversal divergence inside this territory we marked in the higher timeframe. From this point on, the fractal hybrid divergence works exactly like the fractal reversal divergence. The difference lies in the beginning of the process. In other words, in the fractal reversal divergence we only use reversal divergences that repeat themselves in various degrees. In the fractal hybrid divergence, we start the analysis by identifying a hidden divergence, and then we use reversal divergence in all the next degrees. As you can probably imagine, the fractal hybrid divergence is not as common as the fractal reversal divergence, which makes it an even higher probability trade idea. The moments in which this technique appears are truly one of a kind, especially if they have a logically consistent context surrounding the technique. In the next lecture, we are going to study a brand new price action technique called fractal bar that can only be derived from the study of fractal divergence. It is impossible to reach the conceptual idea of the fractal bar without understanding everything we have learned so far in the course. In this lecture, we are going to study the price action element called fractal bar or fractal candle depending on your preference. The fractal bar is a concept that can only be achieved by studying the different techniques under the fractal analysis and the precise relationship between the peaks of the relative strength index and the peaks of price. There is a lot more going on in price and momentum extremes than what meets the eye. Roughly speaking, the fractal bar is a way to spot a second-degree fractal reversal divergence without jumping between timeframes. We do that by analyzing the precise alignment between price peaks and the relative strength index peaks. That's the way this is done because a divergence in a lower timeframe has some effect on the relative strength index of a higher timeframe. However, this effect is very subtle, so most people simply gloss over it, and therefore, miss the opportunities that come along. To be more precise, when we talk about the alignment between price and momentum peaks, we need to understand the idea of momentum offset. Most of the time, the price extremes align exactly with momentum extremes in the relative strength index. When a fractal bar appears on the chart, the momentum peak is slightly offset to the left. That basically means there is a reversal divergence happening in a lower timeframe. That's quite useful because it diminishes the need to jump between the timeframes so often while maintaining the benefits of doing it. It's a win-win situation. We call the bar in which this momentum offset happens the fractal bar. This bar doesn't need to have a specific relationship between its body and tails necessarily. It's more about the momentum offset observed. However, as we are going to see in future lectures, if a fractal bar has some attributions that agree with the context of a hypothetical trade, it's an even more powerful technique to have in the arsenal. It's relevant to point out that fractal bars spiral off from the idea of fractal reversal divergence, but they can appear within the context of a fractal hybrid divergence that has 3 degrees or more. If you studied the last lecture well enough, you will understand that this can happen because, from the second degree and below, fractal hybrid divergences are exactly the same as fractal reversal divergences. For example, we can have a fractal hybrid divergence by spotting a hidden divergence in the 4-hour timeframe and a fractal bar in the 1-hour timeframe. In this case, it would be a third-degree fractal hybrid divergence because the fractal bar represents 2 degrees, and we obviously have the first degree coming from the hidden divergence. If these ideas seem confusing to you at the moment, I suggest that you go back to the previous lectures and study them a few more times. By doing that, you will be more prepared to move on to the next lecture where we overview a series of real market examples of the fractal flow strategy techniques. In this lecture, we are going to introduce the idea of auxiliary tools that help enrich the context of our trades. The auxiliary tools we are going to use in this course are the 2 types of support and resistance lines and the nuanced price reading, which aims to detect the subjective interpretation of the relationship between candle body, candle tails and candles themselves in various situations. The combination of these tools with the fractal flow strategy techniques, and the notion of market trends that we are going to explore in future lectures is absolutely critical for the successful construction of a good context for your trading ideas. To trade successfully in the markets, you will need to find moments in which all these techniques and tools agree with each other. That's the best way of finding high-probability opportunities. In the next lecture, we are going to explore the 2 types of support and resistance lines and their attributes. In this lecture, we are going to examine the important idea of support and resistance lines in its 2 variations. The most common of these variations is the horizontal type. The less common, and perhaps more powerful variation is the slope type. Before we go into greater detail about the more advanced use of these important lines, let's overview the basic structure that holds this concept in place. Support and resistance lines are basically barriers that price tends to respect based on the idea of market memory. When traders analyze the recent past of price, they tend to look at price extremes as areas where buyers or sellers might show up again. That happens to be the case many times. The other common attribute of support and resistance lines is their switching dynamic. For example, if price encounters a support line, tests it a few times, and then zoom it down, this support line switches from support to resistance because price is now below the line, and it has already been tested as a valid barrier for price. The opposite is also true, of course. If price encounters a resistance line, tests it a few times, and then zoom it up, this resistance line switches from resistance to support because price is now above the line, and it has already been tested as a valid barrier for price. Another attribute that is worthy of pointing out is the fact that such lines can act as a barrier, but they can also act as a catapult for price. For example, if price decides to break a support-resistance line, it will do that with an increased volatility most of the times. We call this movement a zoom through the line. This is the basic framework of support and resistance lines. Now let's move on to a more complicated idea, which involves the principles of multi-timeframe analysis and the hierarchy of signals. Previously in the lecture, we talked about the idea of market memory, and how this is the underlying principle that holds the idea of support and resistance lines in place. However, the notion of market memory is relative to the temporal observation of the market. For example, in the daily chart, a support-resistance line might come out of a high or low that happened 20 days ago. On the other hand, a meaningful support-resistance line on the 5-minute chart might come from a high or low that happened only 1 hour ago. This basically means that the power of these lines is attached to the temporal framework in which they appear. The cool thing about using contextual trading, multi-timeframe analysis and the hierarchy between trading signals is that we can use support-resistance lines from higher timeframes to build a trading context for lower timeframes. The true advantage comes from the hierarchy between trading signals. To understand this idea, just imagine the power of a support-resistance line that comes from the 4-hour timeframe on a context built for the 5-minute timeframe. The line drawn in the 4-hour timeframe has a lot more power attributed to it, so it might sparkle a more violent reaction in lower timeframes. With that said, we can advance this principle even further by understanding the less common application of support-resistance lines, which is the sloped or angled type. Sloped support and resistance lines work under the exact same principles as the horizontal type. The only difference is that these lines have to be drawn in some sort of angle to fit under this category. The possibility to draw sloped lines that function within the same axioms that sustain the idea of horizontal support-resistance lines poses a huge potential. That happens because by drawing such sloped lines, we can find many different market angles that would simply pass unnoticed otherwise. The idea of sloped support-resistance lines gives rise to the idea of energy points in price. An energy point is a level where two support-resistance lines with different angles meet. That can happen when a horizontal line meets a sloped line or when two or more sloped lines meet in a common point. The idea of energy points is that when they converge to the same point or level, they produce an amplified effect on the attributes of common support-resistance lines. These energy points can be useful to place target orders, for example. Another interesting property of sloped support-resistance lines is the fact that we can extend these lines to other important highs and lows in the market respecting the angle in which they were originally drawn. This is a powerful technique that might greatly enrich the context of a trade and point out to the edges of the market with an almost perfect precision. However, these types of lines have their downside. Since a trader can find an incredible amount of these in any given market scenario, the trader should be careful in selecting the lines he is going to use in his context formation. There is a large set of lines that can be found in the market at all times, but only a small subset of these lines is valid. The antidote to this problem is to reverse engineer the context by using these lines after some other converging points between other techniques have been found already. By doing that, you can select only the lines that seem to be more relevant to your context. Keep in mind that we are only looking at the concept behind the support-resistance lines. These ideas must be implemented in practice in order to be fully understood, as we will do in future lectures. In the next video, we are going to explore the idea of price action reading within the context of bar or candle interpretation. In this lesson, we are going to study price action reading within the context of candlestick reading. This is probably the most challenging part of the course because it involves the principle of subjective interpretation of markets. I say that it can be difficult because sometimes it's hard to come up with a black and white answer about what a candle means exactly. That happens because we cannot fully roll back the chain of causality of the decisions made within a candle period. We need to interpret the candles based on a few assumptions of what the relationship between candle body and candle tails mean. It's paramount to note that an enormous effort has been made over the years to box candlestick in a series of pre-packaged patterns, which is an attempt that has diminishing returns. For example, the same exact candle can mean different things in different contexts. Even worse, it might not even mean something useful if it is isolated and doesn't fit within a trading context. That basically means that memorizing different names for certain candlestick patterns is counterproductive. We need to approach price action reading in a more organic and flexible way. Instead of memorizing the name of a candlestick pattern attached to a pre-packaged interpretation of what it means, we are going to establish a few guidelines that will enable you to come to your own conclusions about what candles mean in whatever context they might appear. In order to do that, we need to establish 4 different angles in which we are going to analyze specific candles on the chart. The first angle is called relative volatility, which is the perceived volatility of the candle being analyzed in relation to the surrounding candles. High volatility candles are simply larger than low volatility candles. However, this idea of larger and smaller depends entirely on the frame of reference. For example, the candle X can be considered high volatility if compared to candle Y as a frame of reference. However, it can be considered to have low volatility if compared to candle Z as a frame of reference. Recognizing the relative volatility of a candle is important because that indicates moments where buyers or sellers start a significant move. This moment by itself can be used later on as a non-obvious level that will compose a trading idea. The second angle is called shape interpretation. This is where we attempt to roll back the internal history of a candle by looking at the relationship between its body and its tails. This combination of body and tails is what forms the abstract idea of candle shape. There is no better way of grasping this concept other than practicing. In this lecture we are going to see a few conceptual examples. Later in the course we will observe the real application of these ideas. The third angle of price action analysis under the light of candle interpretation is called relative position, which points to the position of the current candle in relation to the previous candle. This is where the notion of inside and outside bars comes from. An inside bar is when the entire candle being analyzed is constrained within the range of the previous candle. An outside bar or outside candle is when the range of the candle being analyzed completely engulfs the previous candle. Once again, without the temporal frame of reference, it is impossible to determine if the candle has an inside or outside relative position. The fourth angle used in candle interpretation is called bar quality, which is simply the determination of which market player dominated the bar. That's a straightforward analysis because a candle in which the close is higher than the open is dominated by buyers. A candle in which the close is lower than the open is ultimately dominated by sellers. Let's practice these 4 angles in a few conceptual examples, remembering that the complete understanding of how to interpret price action only comes from practicing it a lot. In candle 1, we can notice that it has a lower volatility than the previous candle, which shows the market slowed down at least for the candle in question. By looking at the shape of this candle, we can see that it has a large body and small tails. This can be interpreted as a sign of dominance of one type of player in this candle. It also shows an idea of certainty because there is not much evidence for the activity of the less dominant market player in this candle. However, if we look at the relative position of this candle, we can see that it is completely constrained within the range of the previous candle. This idea changes the interpretation we have so far a little bit because an inside bar doesn't agree with the idea of dominance of one market player over the other. This can lead us to believe that the sense of dominance achieved by looking at the first 2 angles of the analysis could be shallow. Under the light of the fourth angle, we can see that this candle is a bullish candle and the dominant market player were the buyers, of course. By looking at these 4 elements, we can form a bias about what this candle might mean in a trading context. Keep in mind that we are looking at only 2 candles with no other element influencing the analysis, so there is only so much information we can obtain here. Let's look at a more interesting example. Here you can see that the relative volatility of the candle in question is a lot higher than the previous candle. This shows an increased interest in the market. However, the really interesting analysis comes from the shape interpretation of this candle. Here we can see that this candle has a small body and an unusually large upper tail. One interpretation that can be achieved here is that buyers were stronger than sellers at some point inside this candle, but ultimately the sellers dragged the buyers down near the end of the candle. Another possible interpretation which is slightly different is that buyers were consistently stair-stepping the market up until they reach a point where they opened a door and saw angry sellers ready to bring the market down violently. These 2 interpretations vary slightly, and a more precise interpretation would require more information coming from other price action elements. The relative position of this candle in question is also interesting. We can see that it is an outside candle, which helps to confirm the power of the sellers involved in this candle. Last but not least, we can see that this is a bearish candle, which in this case is rather obvious, but there are situations where the candles will give you mixed signals about the market player who was dominant in the candle. For example, a mixed signal here would be a bullish quality in this candle, which would contradict a little bit the interpretation of the other three angles. In the next lecture, we will start to understand how to analyze market flows and market trends. In this lecture, we are going to study how we can approach the market in order to determine its trend. As it is usually mentioned, determining the trend of a market is quite useful because trading with the flow of the overall trend is a lot easier than trading against it. To begin understanding how to read the markets and the proper way to establish the trend, we need to grasp the concept of market structure. The market structure is composed of undeniable facts that a trader can read on a price chart. These facts relate to relationship between buyers and sellers in the market. The fundamental unit of measure of market structure are the market vectors. In other words, the vector between a high and a low or a low and a high. When we look at the charts, we can observe a series of market vectors and determine that they form patterns. For example, when price makes higher highs and higher lows, we observe the market vectors stair-stepping up. If we look at this idea more closely, we can see the logic behind this intuition of uptrend that comes from higher highs and higher lows, and also the intuition of a downtrend that comes from lower highs and lower lows. We can view the highs as the ultimate attempt of buyers to drive the market up, and the lows as the ultimate attempt of sellers to bring the market down. In an uptrend, the buyers are stronger than sellers, so they can produce higher highs. In a downtrend, the sellers are stronger than the buyers, so they can produce lower lows. That's an incredibly simple idea, but that's the fundamental nature of how price behaves on a chart. However, as you are about to find out, simple does not necessarily mean easy because of the fractal nature of the markets and the inherent level of complexity attached to the chain of causality of price. This complexity begins to show its face when we first recognize that there are multiple types of players in the market. In other words, there are traders with different amounts of capital power looking at the charts in different timeframes. This variation is what makes the simple mechanism of buyers and sellers complicated to observe sometimes. The problem is that we can usually see different herds of market players in the same chart. This brings us back to the notion of the flows in the market. In one single timeframe, we usually can observe at least a major market flow and a minor market flow. This touches in one of the hardest problems of trading, which is identifying where these flows shift and the hierarchy of power between them. Remembering that fractal means pattern that repeats inside itself, we can try to identify different market flows in the same timeframe. This is where the principle of subjective interpretation of market comes into play. Two different traders counting major and minor highs and lows on a chart might arrive at different conclusions about which highs and lows belong to the major flow and which highs and lows belong to the minor flow. It's important to notice also that there is a hierarchy of power between the major flow and the minor flow of the market. This relationship is mediated by what we call market memory, which is how much past information the current market remembers and respects. This is relative to the timeframe under analysis, of course. That's a tricky part of analyzing market flows because sometimes the minor flow will have more power than the major flow, and that is due to the interference of market memory. This is a situation that many traders have experienced in one way or the other. For example, imagine that you build a context for your trade idea by looking at the most obvious highs and lows on the chart, which usually come from the major flow. When price finally arrives at the place you were expecting it to have one type of reaction, you get caught by surprise because the market is the exact opposite of what you predicted. The reasons for this is the lack of attention in the minor flow and the failure to understand that the highs and lows you have used to form your context are not part of market memory anymore, so the minor flow seems to win over the major flow. Once again, understanding this subtle flow-shifting nature of the markets is one of the most challenging aspects of trading, and it is also a critical one. The identification of a flow shift in the market depends on several contextual factors, so the better you are at building trading contexts and reading the market organically, the better you are going to be at identifying these subtle flow changes. Another critical aspect of market structure is the notion of confirmed market structures and fake market structures, which recognition depend entirely on the candlestick reading of the highs and lows. This is also paramount to understand because most of the times, we will use only confirmed market structure to place our stop-loss orders. The logic behind that is quite simple. A confirmed market structure, as it was alluded in the beginning, is an undeniable fact in the charts. For example, a low is only confirmed when price surpasses the last high. By the same token, a high is only confirmed market structure when price surpasses the last low. That's fine, but there is a very important catch here that adds another layer of complexity to this story. Sometimes, price surpasses the last high or low, but it doesn't close above or below it. In other words, price only pierces the level in which a market structure would be confirmed. This is often the work of market makers who are attempting to employ their manipulative maneuvers on unadvised retail traders, which is a deeper subject that is outside the scope of this lecture, and it will probably be explored in another video course. That brings us to the notion of fake market structures, which is when price only pierces the level that is supposed to confirm the last high or low. As the name suggests, we cannot rely on these types of structures as a solid place to put a stop-loss order because most of the times, these fake structures are made to be broken, so putting a stop-loss near them is a bad idea. By now you must be able to recognize that the simple mechanism of highs and lows in the market creates a few challenges that are not so simple. We need to pay attention to the different flows of the market and the points where they collide. We need to make the correct judgments about the hierarchy between the major and minor flows, and we need to classify the highs and lows of the market between confirmed and fake market structures. Keep in mind that in this lecture, we are only exploring the conceptual part of what we should be paying attention to in a chart. It's difficult to condense all the nuances of the practical application of these ideas into their purest forms because the markets have many different scenarios, and these ideas happen in many different ways. Once again, the best way to study these things is by observing the way they happen in real charts, which is what we will do in the lectures that contain trading examples. In this lecture, we are going to make a brief introduction to the incredibly important and necessary idea of risk management. As it has been mentioned quite a few times in this course so far, it is impossible to become a consistently profitable trader in the long term without applying the basic principles of risk management. Most traders who enter in the market have a primal intuition that making money consistently is all about having very high win ratios. As you might have probably experienced for yourself, it is extremely hard to sustain a high win ratio over long periods of time due to the nature of how markets change from time to time. This means that over the long run, the win ratio of a professional and consistent trader will not be as high. However, that's perfectly okay because we have the amazing mathematical properties of risk-reward ratios to help us as traders achieve the best results in the long term, which is the only thing that matters after all. It's pointless to have good performance in the short term if you are unable to sustain it for an unlimited amount of time. You don't want to be the kind of trader who makes money super fast, but loses all his earnings even faster. It's never enough to stress out that risk management cannot function properly without high-quality technical analysis and deep trading psychology, otherwise we would be able to make money by opening random trades in the market, and we know that this is not the case. For us to collect the benefits of the risk-reward ratios, we need to be able to trade near the edges of the market and we need to train our minds to support losses without triggering certain emotional pitfalls. The first goal is controlled by technical analysis. The last is managed by trading psychology. Without any further ado, let's move on to the lecture that deals with the idea of risk-reward ratios. In this lecture we are going to explore the central element of risk management, which is the risk-reward ratio. The risk-reward ratio is simply the ratio between how much a trader risks and how much he expects to earn in a given trade. In other words, the ratio between the stop-loss order and the take-profit order. By the way, this is one of the reasons it is important to know your targets before you enter a trade. If you don't have any idea where your target might be, you cannot define the risk-reward ratio of your trade, and therefore, you cannot judge if such trade has enough headroom to become a high-quality trade. The risk-reward ratio is so important because it guarantees that we will expect to earn more than what we risk not only in each given trade, but in the long term as well, which is really critical. This brings us to the concept of expectancy, which can be defined as how much a trader can expect to earn in each trade based on the average risk-reward ratios of his past trades. This is why some modes of trading that completely dismiss risk-reward ratios easily fall apart over time. For example, a trader who is after immediate and small rewards and moves his stop-loss a lot to accommodate his biases is silently producing an expectancy lower than 1. This is a deadly mistake for a few different reasons, but the most basic one is that mathematically and statistically speaking, all this trader is doing is expecting to earn less than what he risks, which obviously makes him lose money in the mid and long terms. There is also a severely toxic psychological feature attached to this type of trading because, in the short term, this trader will feel great about his small and subsequent rewards. He will feel like he is really building something great. The problem is that a trader cannot go around the laws of mathematics, so in the mid and long term, it becomes less and less likely that this trader will be able to maintain a high win ratio. In fact, there is too much hype around the idea of win ratios. As you will find out in this course, a trader can make money being wrong most of the time in his decisions, as long as he maintains other aspects of the strategy intact. Before digging deeper into the study of how risk-reward ratios function and their amazing mathematical attributes, let's solidify the idea of expectancy first. Once again, the expectancy of a trading strategy is the average of the risk-reward ratios used in all past trades. For example, in this two tables you can see the risk-reward ratios used in the last 5 trades of 2 trade samples. If we discover the average of these ratios, we will arrive at the expectancy of this strategy. Notice that in Table 1, the strategy uses ratios that range between 1 to 3 and 1 to 5. In Table number 2, the ratios are below 1 because the trader has no real rules on how to manage risk and basically improvises his stop and target decisions based on instinct, which is a really bad idea as we will study later in the trading psychology section of the course. If we take the average of both tables, we can see that Table 1 has an expectancy greater than 1, and Table 2 has an expectancy lower than 1. All this means that the trader using the strategy number 1 can expect to win more in the long term. Meanwhile, the trader producing the strategy number 2 can expect to make less than what he is risking in the long term. In other words, he can expect to lose money in the long term. However, there is a cynical catch at play here. In the beginning of both strategies, both traders will have completely different mindsets. Trader number 1 will probably be a little disappointed because his win ratios won't be that great. However, Trader 2 will be building his confidence to dangerous levels due to the high win ratio of his strategy. This is a very misleading exercise. Trader 2 is not aware that his high win ratio only exists because his targets are too close to his trade entries and his stops are too far away. This configuration tends to produce a high win ratio in the short term, but it is doomed to fail over time because, at some point, the market will go against Trader 2 and he will be stopped out. That will wipe out most of his small profits and he will be emotionally devastated. On the other hand, if Trader 1 is capable of being mature enough to know that a high win ratio is not necessary to make money in the long term, he will continue on his path to become consistently profitable over time. This is a perfect example of what trading really is. This is also a lot like the old story of the tortoise and the hare. The hare is too fast, and it burns itself out too quickly. The tortoise slowly but surely gets where it wants to go. That does not mean that Trader 1 cannot have peaks of performance. The better the performance, the better it is for your capital of course, but high performance must occur within a certain framework that will guarantee its sustainability in the long term. After all, nobody starts trading with the goal of making money quickly, and then losing it all even faster. The bottom line regarding the notion of expectancy is that your expectancy level should be higher than 1. For this lecture, it is important that you understand how the idea of risk-reward ratios dwell at the heart of risk management, and how it affects the trader's behavior in the short and long terms. In the next lecture, we are going to look at the margins of error that risk-reward ratios provide, and we are going to define the best range of ratios in which you should maintain your trades. We already have a firm grasp on the idea of risk-reward ratios and overall expectancy of a strategy, which comes from the average of ratios produced over a certain period. The expectancy is a good metric to measure the risk health of a trading strategy. In this lecture, we are going to look at a more specific attribute of risk-reward ratios, which is the margin of error that they offer. For each level of risk-reward ratio, the trader obtains a percentage of margin of error in which he can rely on. For example, if you trade consistently using a ratio of 1 to 3, you can be wrong 75% of the time in your trade decisions and break even. That happens because for every profitable trade you can make 3 losing trades and break even. Let's see the mathematics of that in a quick example. Imagine, for simplicity's sake, that in every trade you make, you risk 1% of your capital and you expect to win 3% in return. We clearly have a risk-reward ratio of 1 to 3. Imagine also that you have made 2 profitable trades in a row, producing a 6% return on your capital. Since you lose only 1% of your capital if you are wrong in your decisions, you can be wrong for the next 6 trades. Imagine that you end up being wrong in the next 6 trades and you end up breaking even. Let's calculate your win ratio. You made a total of 8 trades and you lost 6 of them. In other words, you were wrong in 75% of your trading decisions, and your win rate was only 25%. By using a good ratio like 1 to 3, you were able to protect your initial capital even while being wrong 75% of the time, which is a lot. Let's look at the different margins of error for the different ratios so we can take this whole analysis to the next level. Here we can see something interesting. As we increase the ratios, the margin of error obviously increases, but the size of the increment decreases. We can observe that by calculating the increment in the margin of error obtained with each ratio. For example, a 1-to-1 risk-reward ratio gives us 50% of margin of error, while a 1 to 1.5 risk-reward ratio gives us 60% of margin of error. The increment between these two levels is 60% minus 50%, which results in a 10% increment in the margin of error when we jump from the first level to the other. If we plot the increment column in a chart, we will notice that a decreasing logarithmic curve appears. In practical terms, this means that in the beginning of the table, the increment we get with each risk-reward level is high. After a certain point, the increment in the margin of error starts to get smaller and smaller while the risk-reward levels increase arithmetically. If we want to have some sort of statistical edge in the markets, we must choose a range of risk-reward ratios that is realistic at the same time it provides a good margin of error. In the beginning of the curve, the margins of error are not so good. More towards the end of the curve, the margins of error are good, but the ratios are unrealistic in a trade-to-trade basis. That does not mean that making a trade with 1 to 10 ratio is not good. It's just not realistic to expect that in every trade. Most of your trades should live within the 1 to 3 to 1 to 5 ratio, but occasionally you will find exceptionally good trades that will stand out, and that's perfectly fine, of course. The ability to trade having a good and realistic margin of error is the most important aspect of risk management because that's precisely what guarantees a certain level of emotional stability and peace of mind for the trader. That's because the trader will not feel the pressure of being right all the time, and he will still be able to make money. This risk configuration also avoids the bad psychological cascading effects that can happen when traders attempt to be correct all the time, as we will see in future lectures. The essential point of this lecture is to show you the optimal range of risk-reward ratios and how we conclude that this is the optimal range. In the next lecture we are going to explore the idea of risk contraction and expansion. In this lecture we are going to learn an idea that serves the purpose of leveling the trading playing field in terms of risk-taking. It's not an absolute necessity to employ the techniques of risk contraction and expansion, but if you want to obtain the full effect of the margins of error of the various risk-reward ratios, you need to level the risk you take in all trades. In real-life trading, the size of your stop losses will vary. That means that the good properties of risk-reward ratios can get a little distorted to the worse side of the spectrum. For example, imagine that you have this series of 4 trades. You can see that the size of the stop-loss orders varies quite a lot in terms of pips. The largest stop is 30 pips and the smallest one is 5. If you end up being right on the smaller trades and wrong in the larger trades, your margin of error can suffer. This is where the idea of risk contraction and expansion comes into play. The goal behind this idea is to use leverage to make all trades risk the same percentage regardless of the stop size. That way, no matter how large or how small the stop-loss orders are in terms of pips, you will always risk a fixed percentage of your account. You can have a clearer view of your margins of error in that way. Let's see how we can calculate the trade size with a simple formula. The formula is quite simple, and it goes like this. The trade size in lots equals the arbitrary risk in terms of capital divided by the size of the stop loss in terms of pips divided by 10. To discover the arbitrary risk in terms of capital, we need to know our equity and we need to define an arbitrary risk percentage. For example, let's say that we have $100,000 and we want to risk 1% of that in each trade. Our arbitrary risk in terms of capital equals 100,000 times 1%, which is $1,000. We divide that number by the size of our stop loss in terms of pips, which is 20 in this example. Then we divide that number by 10, because we know that one standard lot has a pip value of $10 per pip. The formula returns the amount of lots we need to purchase in order to make our trade risk exactly 1% of our equity with a 20 pip stop loss. Let's do the reverse calculation to prove our formula. We know that one lot gives us $10 per pip. The formula returned 5 lots, so our trade would function with $50 per pip. If we got stopped out, we would lose 20 pips at $50 per pip, which gives us a $1,000 loss, which is 1% of our equity. This is how you can quickly calculate the size of your trades if you wish to level the playing field in the way that we described in this lecture. In the next video, we are going to talk about different methods of position sizing and how you can grow your account in an organized way. In this lecture, we are going to explore 2 different methods of position sizing. Position sizing is how you manage your trade's size in order to grow your equity in the most efficient way possible. There are many different types of position sizing methods, but we are going to explore 2 simple methodologies that tend to yield the best results and don't require complex mathematics to calculate the size of your positions. The first method is linear, and we must establish an equity threshold to change the size of our positions. For example, if we establish that our threshold will be 100%, we will only adjust the size of our positions once our equity has doubled. In other words, when it has achieved 100% return. We also need to establish an arbitrary risk level or arbitrary amount to every trade we make. Here you need to decide if you are going to use risk contraction and expansion as it was explained in the last lecture. Let's create a hypothetical example to illustrate how the linear threshold method would function. Imagine that we have an equity of $10,000. In this example, we will use risk contraction and expansion, so we will define our arbitrary risk percentage as 1%. That way, every trade we make will risk 1% of our equity regardless of our stop-loss size. Our threshold will be 100%, so when the account reaches $20,000, we will adjust the size of our trades again, but not until it hits this threshold. 1% of $10,000 is $100, so in every trade we make under the linear threshold method, we will risk $100 until we hit $20,000. Once the threshold is met, we adjust the size of our trades to 1% of the new equity, which is $20,000. From that point on, we will risk 1% of $20,000 until we reach the next threshold of 100%, which will be $40,000. The established threshold can vary, of course. The lower the threshold, the more risk you will be taking, and consequently, the faster your account will grow. However, remember that more risk can also mean larger losses, so be fully aware of that before you decide on which position sizing method you will use. Remember also that you should not use an arbitrary risk that is too high. The reason for that is that the more risk you assume, the more you will be bound to suffer from an amplified state of the cognitive biases that we will be studying in future lectures. The less risk you take, the easier it will be for you to deal with your losses and to manage your emotions in real time. The ideal scenario is for you to find the optimal arbitrary risk level in which you feel comfortable enough to open a trade when the opportunity appears, but you also don't get overwhelmed by amplified emotions. If you want to use the linear threshold method without risk contraction and expansion, you will need to determine a fixed amount to open your trades based on your available margin. That is correlated with your available account leverage, but as a rule of thumb, you should not use more than 5% of your available margin. The procedure regarding the adaptation of the trade size is similar to the example where we use risk contraction and expansion. The only difference is that without risk contraction and expansion, instead of defining an arbitrary risk percentage, you will define an arbitrary margin percentage for your trade. For example, let's imagine that you have $10,000 in an account with 1 to 200 of leverage. You also defined your arbitrary margin percentage as 3%. Since you will be using 3% of 10,000 at 200 of leverage, you will be purchasing 60,000 units, which gives you $6 per pip. Once again, these numbers are completely arbitrary because they depend on your subjective experience of risk. Just remember to not exaggerate because you want to make money fast. That's never a good idea. The other position sizing method that we will be exploring is an extrapolation of the linear threshold method, and it's called moving threshold. Consider that every time you close a position, you have a new threshold, which is the available equity in your account. This can also be viewed as risking a fixed percentage of your available equity in every trade. This is a more aggressive approach that can work for or against you depending on your performance. All you need to do is to establish an arbitrary risk percentage for your trades and make sure that all trades fit that arbitrary value, just like you learned in the risk contraction and expansion lecture. For example, let's say you have $25,000 and you want to risk 3% of your account every time you make a trade. All you need to do is use the risk contraction and expansion formula you learned in the last lecture to adjust the size of each trade. The main difference between the linear threshold and the moving threshold method is the nature of how the arbitrary threshold shifts. The method that you are going to use is completely up to you due to the subjective nature of how each person interprets risk and your tendency to be risk-seeking or risk-aversive. In the next lecture, we will be exploring the idea of shooting stops forward as a method of relieving the pressure of constant risk-taking in the market. In this lecture, we will study the idea of shooting stops forward, which is a way of viewing risk-taking in a way that diminishes the psychological pressure that comes from constant risk exposure in the market. It serves also as a psychological weapon that aims to neutralize the bad emotions that come attached to a losing trade. Trading is not an easy task and traders are far from being perfect because we have many silent psychological flaws. That reality poses a challenge to the trader who responds too negatively about being wrong in his decisions. As we already learned, consistently profitable trading can and will probably be done being wrong most of the time, which is a practical necessity due to the way risk-reward ratios work together with the idea of trade location. However, the great advantage of using the correct risk-reward ratios gives us the possibility of being wrong most of the time, as we already saw in previous lectures. In this video, we will extend this idea a little further with the concept of shooting stops forward. When we risk our capital in the market, especially if we use risk contraction and expansion, we expect to win a certain amount and we expect to lose a certain amount that seems tolerable to us. If we view every trade as a summation of stops, we can have an objective mechanism to create a positive psychological effect that diminishes the bad feeling of losing and regulates the good feeling of winning. Let's suppose that you use risk contraction and expansion, and you risk 1% of your capital in each trade. Instead of viewing that risk as a 1% risk, you can view it as a one-stop risk. You are risking one stop expecting to make 3 or 4 stops with your targets. If the first trade you make is a winner, you can be wrong for the next 3 or 4 trades depending on the ratios you use. If you start with a losing trade, you know that all it takes is one good trade to neutralize the losses generated by 3 or 4 bad trades. The idea of shooting stops forward is quite simple. You simply count how many stops you earned as a reminder of how much you can be wrong without losing capital. For example, let's imagine a hypothetical situation where you win and lose trades in an alternating manner. This won't happen in reality, of course, but it serves to show you the idea of shooting stops forward. With each trade, you count how many stops you earned the right of being wrong in the future. That gives you peace of mind to continue risking your capital without the fear of losing the next trade just because you lost the last trade. That's incredibly important, as you will find out in practice. In the next lecture, we will begin the study of the trading psychology section of the course. In this lecture, we are going to make a brief overview of the topics contained in the trading psychology section of the course. At this point, it's almost a cliché to say that trading psychology is absolutely necessary for any trader to not only survive, but to succeed in the long term. However, most traders don't stop to wonder why that's the case, and if they do, they almost never go deep enough into the topic, which is immense. It's not only a deep and wide subject, but it is also quite interesting because it deals with the rather mysterious nature of the human mind and some weird aspects of it. It is also interesting to find out how the human mind became what it is today and the mechanisms that led to this transformation over thousands of years. In the trading psychology portion of the course, we are going to study 2 main topics, which are the prospect theory and the relevant cognitive biases that affect traders the most. The prospect theory earned a Nobel Prize in economics, and it was discovered by a psychologist who happens to be a reference in behavioral economics to this day. The prospect theory makes it easier to understand the contradictory nature of how our brain works when we expose it to decisions that involve risk. The heart of the prospect theory shows how we can display aversive or seeking behaviors to the same problem depending on how this problem is framed. This has a major impact for traders because we need to deal with this sort of thing every time a trade is made. The other part of the section about trading psychology deals with the relevant cognitive biases that tend to hinder a trader's performance if he's not aware such thing exists. Cognitive biases are primitive lenses by which we observe the world. They are second nature to us, and many of the activities that we perform on a daily basis and that we take for granted would be impossible without them. Things like learning, memory articulation and decision-making are deeply connected to the cognitive biases. The other attribute of cognitive biases is that all human beings have them without any exception. They precede personality in a way. That's how deeply embedded they are in our biology. As you will find out later in the course, the presence of the cognitive biases in modern society creates something called the intelligence paradox, which is one of those real-life ironies that spiral off of the complexity of our existence. It's quite easy to underestimate the effect of cognitive biases in our trading because they are silent to us in a way. The fact that we have a hard time seeing biases in ourselves is itself a bias called bias blind spot. Once again, that's because cognitive biases are primal intuitions deeply rooted in our biology, and they come from behind us in a way to shape the way we see the world. The study of these two aspects of our psychology help to clear up the fog that surrounds the unique behavior of human beings regarding risk associated with time, which is a major part of trading. In the next lecture, we are going to dig deeper into the prospect theory to understand its amazing conclusions about human psychology. In this lecture, we are going to study a critical aspect of human psychology applied to decision theory in the financial markets, which comes from the understanding of the prospect theory. The prospect theory is so important that it won a Nobel Prize in economics, and it was discovered by a psychologist, which is the man you see in this picture who happens to be a leading authority in behavioral economics. There are two modes of reaction a trader can have when facing a decision in the market, roughly speaking. The trader can seek risk, or he can avoid risk. The hallmark of the prospect theory is that it shows how a person can shift between these two modes regarding the same scenario. The only thing that makes the person shift between risk avoidance or risk seeking is how the decision is framed. In other words, the way in which a person sees a decision is what determines if she is going to seek risk or avoid risk. The interesting thing about this is that the person can shift between risk aversion or risk-seeking behavior just based on how the situation presents itself. That happens because human beings make decisions based on something called heuristics, which are simplistic and automatic decision-making rules that run automatically in the brain. These heuristics are effortless and second nature to us because human beings evolved over thousands of years with the need to make decisions in the quickest way possible, which does not mean these decisions will be made in the best way possible. These are two completely different things. The field of evolutionary psychology claims that our ancestors had to make quick decisions to avoid dangerous situations, and that's how these mechanisms got engraved in our nervous system. As we will see in future lectures, the presence of these heuristics and cognitive biases is a paradoxical practical necessity of our existence, but let's leave that to a moment where we can focus more precisely on why that's the case. For this lecture, it's important to understand the core and axioms of the prospect theory. The heuristics and biases associated with the decision-making process are wrapped by something called bounded rationality, which is composed of three elements. The available amount of information in the moment a decision is made, the time constraint that envelops the decision-making process, and the cognitive limitations of the person making such decision. In trading, all three elements of the bounded rationality are attacked in unfortunate angles. For example, the amount of information a person has to make decisions in the market is indeed limited. That's the problem that high-quality technical analysis attempts to solve, and it is already a big challenge by itself. The time constraint of the decision-making process is also a problem in the markets because traders are always running against the clock, which is a reliable way of augmenting the effect of negative cognitive biases and the overall anxiety level of a trader. The cognitive limitations of a trader are no different than the cognitive limitations of anybody else, but a trader tends to put himself in situations where his counterproductive biases get amplified. This almost always ends badly because our biases are not exactly designed to be rational. They are a byproduct of biological evolution to get us out of primitive versions of trouble. Once again, this refers back to the paradoxical nature of modern social animals like us with primitive cognitive biases. To truly understand what the prospect theory means in practice, we can do a few different exercises to show how we can seek or avoid risk depending on how decision-making questions are framed. Consider the two following alternatives and choose the one you prefer. Number 1. 95% chance of winning $100,000. Number 2. 100% chance of winning $94,499. Let your intuition guide you and pick one of the two alternatives. If you are like most people, you probably chose alternative number 2. However, mathematically, and statistically speaking, the alternative that makes the most sense is alternative number 1. Before showing you what that means, let me explain what this example means under the light of the prospect theory. The fact that we generally feel better choosing alternative number 2 shows us how we tend to avoid risk depending on how the question is framed. Most people pick alternative number 2 because of the fear of disappointment. However, statistically speaking, the correct alternative is alternative number 1 because 95% of 100,000 produces $95,000 over a series of equal decisions, while 100% of 94,499 produces $94,499, which is less money. The key here is not to pay attention to what the numbers feel like gauged by our intuitions, but to use mathematics and statistics to discover what the decisions really look like over time. Most people choose the alternative that does not make sense under the light of mathematics and statistics because these things are not part of our intuition. Let's look at a different question to see other types of reactions people might have about this framing problem. Consider the two following alternatives. Number 1. 5% chance of losing $100,000. Number 2. 100% chance of losing $5,100. Once again, this is a question framed to spark risk aversion or risk avoidance. Most people tend to choose alternative number 2 simply because our intuitions guide us to the impression that it is better to leave with a certain small loss than to have the possibility of losing a larger amount. As correct as this might sound, it is mathematically and statistically incorrect. If we analyze these alternatives over a series of equal decisions, we will see that 5% of losing $100,000 makes you lose $5,000 over time, while 100% chance of losing $5,100 guarantees that you will lose $5,100, which is a bigger amount to lose, and therefore an undesirable outcome. After the first exercise, you already know that you should look at these problems using simple mathematics, so you probably picked the correct answer. However, it's amazing to notice how people choose alternative number 2 due to the fear of a large loss. These are the two classic examples of questions framed to provoke risk aversion in most people. Let's now look at two classic examples of questions that provoke risk-seeking behavior. Consider the two following alternatives. Number 1. 5% chance of winning $100,000. Number 2. 100% chance of winning $5,100. From the last two examples, you already know that you should look at this problem under the light of mathematics and statistics, and therefore, you should be able to see that the correct answer is alternative number 2. That's the case because over a series of equal decisions like this, 5% chance of winning $100,000 generates $5,000 while 100% chance of winning $5,100 generates $5,100, which is more money, and therefore, a more desirable outcome. However, as you might be expecting already, most people choose alternative number 1 in the hope of winning a large amount of money. In other words, by listening to their intuitions, most people end up seeking risk unnecessarily. Once again, most people choose the wrong alternative because they are thinking intuitively, not mathematically and statistically. Let's look at a final example that provokes risk-seeking behavior. Consider the two following alternatives. Number 1. 95% chance of losing $100,000. Number 2. 100% chance of losing $94,499. Most people choose alternative number 1 in the attempt to avoid a certain loss. However, we know that alternative number 2 makes us lose less money in a series of equal decisions like this. As you can notice by these four examples, the way decision-making questions are framed using different lenses of high or low probability, winning or losing scenarios, and high or low amounts of money deeply affect the way our heuristics lead us to make choices. It's only through the unbiased lenses of mathematics and statistics that we can erase this effect. Another interesting thing that the prospect theory points out is the asymmetrical shape of the utility function. In simpler terms, imagine that we can attribute a psychological value for wins and losses. The asymmetrical shape of a utility function tells us that winning $100 feels 100 points in the imaginary scale of psychological comfort. However, losing $100 feels more than 100 negative points in the same scale. In other words, winning $100 is not symmetrical to the experience of losing $100. There is a lot to be said about the relation between the prospect theory and the idea of using optimal risk-reward ratios over time in trading. Many traders feel uncomfortable with the idea of using a good risk-reward ratio because their win rates are diminished. That happens simply because it's a lot easier for the market to hit a small stop than to hit a large profit target. This is where the concept of trade location comes into play to save the day and balance things out. Let's observe the prospect theory in two distinct risk configurations in the market. One is a very irresponsible scalping paradigm in which the trader aims for an extremely high win rate, so his stop-loss orders are large, and his take-profit orders are short. The other risk configuration is a more sophisticated one where the trader maintains the ratios between 1:3 and 1:5. This naturally produces a lower win rate, but it guarantees the trader stays in the game indefinitely, unlike the first configuration that is short-lived. The main difference here is that the first risk configuration fails to recognize the importance of projecting decisions over time, which is the main thing that makes most people answer decision-making questions incorrectly. It feels a lot better to make quick and immediate rewards in the market, but that feeling does not last very long. On the other hand, the second risk configuration takes into consideration the mathematical and statistical side of the decision-making process and bypasses the erroneous intuitive feeling that comes from generating a lower win rate. One of the most important lessons a trader can learn is the maturity to grasp the idea that sacrificing an exceptionally high win rate is a practical necessity to make money in the long term. There is no way around the laws of mathematics and statistics. Now you know how your brain can trick you into making the wrong decisions based on what you feel instead of basing your decision-making device on what is universally accepted as reasonable according to mathematics and statistics. In the next lecture, we are going to explore something called the intelligence paradox. In this lecture, we are going to amplify our understanding of something called the intelligence paradox. This is somewhat a deeper notion about behavioral economics, so first we are going to see the paradox in its condensed form so that later we can unpack all the concepts and ideas that are necessary to its full comprehension. The intelligence paradox can be stated in the following sense. The same cognitive biases that enable the evolution of intelligence in the human brain are the same cognitive biases that hinder that intelligence in modern life situations. The paradoxical nature of this statement lies in the notion that the cognitive biases we have are in great part responsible for our survival over thousands of years of biological evolution, and at the same time, these cognitive biases often catapult us towards irrationality, and therefore away from what we consider intelligence in various examples of our modern social life. Before we can understand this idea more clearly, let's first define the idea of cognitive biases. Metaphorically speaking, a cognitive bias is a lens through which we see the world. This lens steers our thought process, behavior, and decision-making apparatus automatically, so most of the time, we are not aware of such biases. It's common to observe people believe that they are being completely impartial about a given subject, while from the outside, it's perfectly clear that they are biased. We have about 150 cognitive biases, and many of them are critical for the way in which we learn new things and for the way our memory works, which is another way of seeing the intelligence paradox. We need certain biases in order to be able to remember what we learn and recall the new acquired skills when we need to. However, when our biases interfere in our emotions, that's where we can get in trouble, especially when we're dealing with the financial markets. The great question here is why we possess these apparently counterproductive biases in the first place if they seem to cause more trouble than anything else. The problem is that the time span of the existence of modern society compared to the time span of the biological evolution of our brains is tiny. That means that for most of the time, our brains have been naturally selected to deal with primitive problems like avoiding dangerous animals in the wild, tribal fights and things like that. Only very recently we have been forced to learn how to deal with modern life situations like trading, in which we deal with the faults of our own existence in a way. Our biases are very good for primal activities without which would be impossible to learn and develop memory. However, these same biases get in our way when we need to make decisions in an economic paradigm. As we saw in the last lecture about the prospect theory, the decision-making process of traders in the markets attacks the bounded rationality idea in unfortunate ways in all three angles. We have limited information to make decisions in the market, so right from the start, a whole branch of cognitive biases that deal with how we recall memory must be triggered in order for us to indeed make decisions. The second element of the bounded rationality, which is time constraint, also triggers a series of cognitive biases that deal with the notion that we must act fast in our decisions. Evolutionary psychology tells us that we develop this urge to make fast decisions due to the survival paradigm in which our ancestors lived. For example, if you were a human thousands of years ago, and you had to decide about the danger of facing an unknown animal, for example, the humans that made quick decisions were naturally selected over the humans that were not quick enough to make such decisions. Remember that fast decisions are not necessarily good decisions. Quick decisions are made for survival, but trading requires well-thought-out decisions. This is why every trader needs a trade plan, which is a way to make fast decisions based on well-thought-out ideas. This is so important that we define the trade plan as one of the dimensions of a professional trading strategy. The third element of the bounded rationality, which is the cognitive limitation of the decision maker, just sums up what we have been talking about in this lecture. Cognitive limitations can be understood as a combination of how amplified the biases can get with the addition of IQ, which is the cognitive ability to articulate and understand abstract concepts. It's important to notice that we all have the same cognitive biases as we are part of the same species, but our personalities vary greatly, and that serves as a catalyst to amplify certain biases and diminish others. If we bring these concepts to a more practical approach of the markets, we are going to notice that we do irrational things automatically, and that's an incredibly dangerous idea. Since cognitive biases are so deeply embedded in our minds, we don't notice when we are being biased, especially if we don't know there is such a thing called cognitive bias, which is the case of most traders that enter in the market. Just like the subtle points of view detected by the prospect theory, the biases control how our thoughts arise in consciousness and how these thoughts will be steered in a way. In this course, we will study most of the relevant cognitive biases that affect traders the most. By doing that, you will gain an edge over the traders who do not possess this knowledge. Another advantage of studying trading psychology more deeply is that we can take precautions that will enable us to avoid certain psychological pitfalls that are guaranteed to happen in trading. However, before we proceed to study the relevant biases one by one, let's solidify the notion of the intelligence paradox to finish this lecture. We already have a good idea of what cognitive biases are, where they came from, and why they are still sticking around with us to this day and will probably do for a long time. The intelligence paradox states that the Homo sapiens would not have developed high intelligence if these cognitive biases were not present to allow our species to survive long eons of time. At the same time, these biases tend to get in our way in modern life situations that are part of our complex social networks and hinder the intelligence they allowed to develop in the first place. That's the paradox. Intelligence could not have been developed without these primitive lenses to guide our ancestors to overcome their simple problems, but since our species did that sort of thing for a very long time, these biases were deeply engraved in our psychology, and now we must know how to deal with them in a different paradigm, which is the modern world. The problem is that these biases were built and naturally selected by the primitive world. It's almost if we had a primitive sleeping ape inside our minds at all times, and the wrong stimulus from the external world is enough to wake up this creature. The problem is that this creature has no idea how to manage its emotions and it acts completely by instinct and is driven merely by survival. That's the underlying psychological structure that goes on when you see a trader punching his computer screen out of anger towards the market. You can probably imagine that letting this metaphorical sleeping ape trade for you is a really bad idea. In the next lecture, we will begin the fascinating study of the cognitive biases and how deep these psychological traps can get. Availability heuristic is a cognitive bias in which a decision maker relies upon knowledge that is readily available rather than examine other possible alternatives to a given situation. It is easier for us to recall information which has recently arrived. The main application of the availability heuristics in trading lives in the difference between building a solid context for a trade and trading by impulse. Building the correct context for a trade situation involves a significant degree of patience and mental effort, but it is the only way we can access the necessary depth of analysis. Unfortunately, the availability heuristics is the natural state of our minds. We tend to use the information that is more easily available simply because it's easier, and we tend to avoid producing cognitive discomfort that comes from deliberating about the details of a situation. A trader who trades with the availability heuristic in an amplified state is not worried about the context of the market or what's happening in the battle between buyers and sellers. This trader only wants a simple trigger to enter and exit the market automatically. Hopefully that does not sound too familiar to you, otherwise you might have to train yourself to dial down your availability heuristic. The way to do that is to first recognize the existence of such bias, and the second is to accept that contextual trading is the correct way to approach the markets. The attentional bias is a cognitive dissonance that makes people be more influenced by their recurrent thoughts. Like the availability heuristics, the attentional bias can easily put traders off track by making them focus on the wrong things. For example, the recurrent thoughts of a trader might make him forget the context of a market for a brief moment. A classic example of this is the trader who watches the news while trading. As far as we can tell, watching the news is only a source of distraction that blurs the correct analysis of the market that it is usually accomplished silently and without external noise. Watching the news might give you the sensation that you are connected to the market. However, this is an illusion, and the sad reality is that, most of the time, watching the news is counterproductive due to the attentional bias. This cognitive bias reflects the tendency people have to start believing information that has been repeatedly exposed to them. In other words, if you hear or see the same information too many times, you have a natural tendency to start believing it, even if you are aware that such information is just an illusion. That becomes a problem in the financial markets when traders are continuously exposed to bad information on how to trade and on how to manage their emotions. The illusory truth effect is quite powerful in the financial markets because there is a lot of people spreading out misleading information about how traders should act. Due to the way our brains are wired, if we don't have a good theory about something, we will end up trusting a bad theory, which to us feels better than no theory at all. There are many ways to trade the market that seem reliable and trustworthy, but many of them are shallow and only look good on the outside. The illusory truth effect plays a big role in letting the wave of misleading information continue to grow. By becoming a little more aware of the illusory truth effect, we can begin to select the information that we use in our trading in a more efficient way. After all, defining high-quality context for your trading ideas is all about weighting information rationally. This is the tendency people have to attribute more meaning to information that is familiar to them. Once again, this spirals from the intersection between our pattern-seeking nature and our inherent need for survival. Trusting familiar information is also a key component in the learning process. In the financial markets, traders tend to display the mere exposure effect in a larger scale because most of the information about how price works is blurry, so it's easy to attach oneself to an idea that makes sense apparently. In other words, in the financial market world, which is chaotic and confusing to most people, a piece of information that makes sense is an unusually attractive beacon of comfort. Here you can see that the very nature of how mysterious the financial markets can be is already enough to mess with our cognitive biases in a counterproductive way. We must develop some kind of filter if we want to have a reliable approach to the markets. Comforting pieces of information like the idea that one can trade without risk, for example, are very attractive, but they are completely misleading, and only serve as a distraction. This is a familiar bias to most people who have some experience in the markets. The mood congruent bias is when your mood affects the types of memories that are triggered in your mind. If you are a trader with a lot of bad experiences in the market, this can be a problem. If you happen to be this type of trader, even a certain type of market scenario can trigger really bad emotions if you are in a bad mood already. Needless to say, it's always better to trade in a relatively neutral state of mind. Too optimistic is not good because it can make you go after opportunities with no real context behind them based on a feeling of shallow hope and pure optimism. Excessive optimism has its place in certain aspects of life, but the financial markets are not one of them. Trading in a negative state of mind is also bad because it can drive you to a downward spiral and a negative cascading effect that usually ends badly. This is also known as the frequency illusion, and it refers to the effect of learning something and subsequently seeing this new thing everywhere. This is also common in the financial markets. It can be a problem when one type of market analysis blurs other necessary ways of seeing the market. This is very common among traders who can only trade using technical indicators. For example, a trader like this can only see the market through the light of one specific indicator, and he cannot begin to understand the market in a multi-layered fashion like we've been trying to do over this course. This is usually a reflex of having poor information about the market. One of the goals of this course is to make the Baader-Meinhof phenomenon a little looser by showing you how a market should be analyzed from different angles and different types of analysis. The empathy gap is a cognitive bias that reflects how people can neglect the impact of primitive impulses in their behavior and choices. For example, when a person is angry, it is almost impossible for this person to understand what it feels like to be in the opposite state. This works in a personal level as well as in an interpersonal level. For example, it can be hard for people to put themselves in the shoes of other people. The result is the underestimation of other people's feelings and an overestimation of our own feelings. We tend to overestimate our own feelings over the feelings of others simply because our own conscious experience is simply more interesting to us. We don't really feel another person's suffering. We can only feel empathy for it, hence the name of the cognitive bias. For the world of trading, since the interaction happens between a person and the price chart, the empathy gap occurs in the personal layer, meaning that the trader will underestimate how the primitive impulses we potentially display under extreme circumstances will influence our behavior and choices to a significantly important degree. One very good example of this is when a trader, who is usually not making use of any risk management methodology, finds himself in a losing streak that deeply affects the overall equity. Let's imagine that this trader was overloading positions, and because the trader was caught in a losing streak, the damage produced on the equity was significant enough to make this trader angry about the loss. Just the sight of the lost capital on the trading terminal is enough to keep the anger momentum going. This circular behavior eventually erupts in a fight-or-flight instinct resulting in violence like punching the computer screen or simply being in shock by the overwhelming reality of the recent events. There's no one to blame here other than the trader, of course. Some traders even try to blame the market in a ridiculous attempt of removing the guilt out of one's shoulders. It's unfortunate to think that what led this trader to this type of behavior is twofold. First, the ignorance about what can happen when traders don't use good money management. Second, the empathy gap on a personal level that made the trader misunderstand that when anger was emerging in consciousness, the correct thing to do would be to simply stop everything and reevaluate. Notice this is extremely hard to accomplish depending on how angry the trader is at the moment. That's why it is necessary that this process is ceased before it reaches a point of no return, so to speak. Some traders don't even know they can experience such emotions in trading. Once again, the first step for preventing this kind of situation is being aware that it can happen and how it happens exactly. There are a few traders that have experienced this many times, and they will continue to do so because they know nothing about the mechanisms that are at play here. It's possible that some of these traders even think there is some sort of psychological problem with them, but that's clearly not the case. It's not wise to exclude that possibility for all cases, but most of the time, the traders don't suffer from any sort of psychological illness. This is just what happens when primitive behaviors are fully triggered. If you think that studying trading psychology is boring, this last example might serve as a source of motivation to get through the boredom. In other words, taking a trading situation to such extreme is trying to apply the primitive wisdom of our ancestors to a modern-day paradigm. It's easy to see that this is absolutely going to fail 10 times out of 10. There is the need for the trader to develop a certain impartial attitude towards one's own emotions. This is a difficult process, and most people don't involve themselves with it because it requires a constant calibration of one's behavior towards everything else. Again, it's never enough to stress the importance of being theoretically aware of such possibilities. The trader who already had these experiences has the practical advantage of evaluating them in a personal way and in an isolated manner, but this doesn't mean it's necessary to have such experiences to really understand that they are bad and that they should be avoided. The best case scenario to prevent biases like the empathy gap and others as well is to never be subjected to the full practical potential of these biases but only to be theoretically aware of them. There is no reason we should think that a person should be subjected to bad experiences in order to really understand what they mean. We must be intelligent enough to learn from the mistakes of others. If we relied on the paradigm that we should experience everything ourselves, it could take more than one lifetime to understand all these things we must necessarily understand to become consistently profitable traders. The omission bias can be categorized as the impression that harmful actions are worse than harmful inactions even when the outcome is the same. This can be easily transported to a trading scenario in the following sense. To generate consistent profits over time, the trader needs to take actions regarding a particular financial instrument. Depending on what type of personality the trader has, actions may be more natural than inactions and vice versa. Imagine that a trader that has more of an impulsive personality trying to trade a particular market with an exaggerated level of aggressiveness. Let's also imagine that the result of this endeavor is that the trader breaks even. In other words, the trader didn't change its capital because the sum of profits and losses during the period was equal to zero. Now imagine that a trader with a passive personality is being too passive about the market to the point that he barely trades at all. The outcome, of course, is break even. The outcome of both personalities is the same in this case. How can we really say which one is worse? We can't arrive at this conclusion objectively because we need to look at them from the angle of the outcomes. Sometimes it's better to be passive about the market and sometimes it's better to be active about the market. The ideal scenario to be in trading is similar to sniper mentality that patiently waits but doesn't hesitate when the right moment arrives. Throwing shots at every single noise you hear would be amazingly wasteful and dangerous at the pace that never shooting at all wouldn't get the job done. Certain actions that appear to be good in the short term can have a disastrous effect in the long term. At the same pace, actions that feel counterintuitive in the short term can have a good effect in the long term. The essential point of this is looking at the outcomes considering the statistical significance of such actions like we studied in the risk management portion of the course and in the prospect theory lecture. This cognitive bias is also known as the isolation effect. When people are subjected to various forms of similar stimuli, or similar types of information, they tend to give more importance to the string of information that stands out the most. This is an obvious reflection of our pattern-seeking nature. This behavioral paradigm is so deeply ingrained in us that we do this automatically all the time. The von Restorff effect is one of the tools used by market makers to confuse retail traders in a subtle sleight of hand. There are many times in the market that large traders intentionally produce abrupt market movements to trigger the impulsive behavior of less advised traders and also to bring the attention to a certain part of the market while the most important parts of the market go unnoticed. This is one of the most cynical secrets about how large traders can literally manipulate the retail traders by using reverse psychology and a type of psychological flaw that is inherent in all human beings, including market makers of course. The difference here is that market makers are fully aware of how such bias displays itself, and they are very proficient at triggering this sort of behavior in other traders. The focusing effect, as the name suggests, is when a person places an exaggerated amount of importance in one event inside a larger context. In the markets, the focusing effect can happen on a regular basis in various situations. The area where this tends to happen more often is when traders analyze their performance. The focusing effect can happen and it's probably more toxic when the trade series under analysis is not large enough to produce statistical significance. For example, imagine that a trader makes 10 trades and uses these 10 trades to evaluate performance. Contained in all these trades are a series of losses and one disproportionately overloaded trade that made possible for the overall equity curve to have a positive result. The focusing effect would happen when the trader in question rationalizes his positive outcome just by the fact that it exists without considering how the trader got to that result in the first place. The way to do that is by just focusing on the large trade that probably had a great deal of luck involved in it. Traders under this paradigm tend to say things like, "I know I'm doing something right because I made profits quickly and that wouldn't happen if I was wrong about my strategies." A statement like this is clearly mistaken if you take into consideration everything that is being said here. Namely, the trader is completely excluding the role of luck in the one trade that made the equity curve profitable. The trader is not considering the factors that led to his losses. The trader didn't use sound risk management to frame the trades. The trader is ignoring the statistical significance of the trading sample. The trader clearly wants to be proven right instead of being skeptical about the results. To achieve the status of being right in this context, the trader needs to reverse the approach. If we attack this trading sample from all angles and it survives, the trader is very likely to be right about the performance being good, otherwise he might be just misleading himself. The framing effect is the natural inclination people have to react differently to information depending on how it is presented. This phenomenon goes hand in hand with the prospect theory, where you have a mathematical explanation of how people tend to avoid or seek risk depending on how the question is framed. The problem is that mathematics and statistics are not intuitive to us. We need to force ourselves to think in these scientific terms. The prospect theory exemplifies this phenomenon in the simplest way possible. The key to understanding the true meaning of numbers and probabilities within behavioral economics is to extrapolate how a particular decision would affect your perception of the problem if this decision was made multiple times. This is, in more complicated terms, the concept of statistical significance. Just look at the expression statistical significance. The word significance is there to show that one simple isolated action carries no explanatory quality about its extrapolated value throughout time. This is the only way to understand these problems in their real sense. This cognitive bias shows the discrepancy between an individual's perceived change of something and the actual change of something. In basic terms, this law states that the relationship between stimulus and perception is logarithmic. In other words, if stimulus varies geometrically, perception varies arithmetically. This idea can be practically observed when a trader risks exponentially larger amounts of capital. The logarithmic relationship of stimulus and perception explains why a trader in that situation keeps doing what he is doing until he is forced to stop. In this case, the Weber-Fechner law explains the trader's reckless behavior. The logarithmic relationship says that if stimulus varies geometrically, which means that it will be multiplied by a fixed factor, the perception will vary arithmetically, which is to say in an additive manner. In practical terms, it would look something like this. Imagine a trader begins risking 1% of the capital, and this trader multiplies this percentage by a factor of 2 in each trade that is made. The series of trades would look like this: 1%, 2%, 4%, 8%, 16%, 32% and 64%. This represents the stimulus. However, the perception of the trader still functions in an additive manner respecting the original value, which was 1%. To the trader, it would feel like risking 1%, 2%, 3%, 4%, 5% and 6%. I said this explains the trader's reckless behavior, because to his point of view, no real significant change is being made in the risk. The reality of the situation is completely different, as you can see. This is one of those unfortunate realities about our minds that seem to have had advantages to our ancestors, but not so much in modern days. If you think about fights, for example, the Weber-Fechner law is very useful to the person who is losing, therefore it is a form of survival or defense mechanism. This might have been selected as a cognitive bias that helped our ancestors to survive uncomfortable stimuli. Individuals who had this bias obviously would have a better chance to survive than individuals who didn't have it. It's a natural way of numbing unnecessarily big perceived stimulus as a defense mechanism.